welcome to Alternative Realities, the podcast by Liquidity.io, where we dwell into the evolving world of alternative investments. I'm your host, bringing you fresh perspective on how investor can navigate changing markets and access unique opportunities and build resilient portfolio with alternatives. Today's episode explores the foundations, why alternatives matter, how they have become more accessible, and the strategic role they play in modern investment portfolios. Let's start with the big question. Why are alternative investment attracting so much attention now, especially among both institutional and individual investors?
That's a crucial starting point. Traditionally, portfolios center around the classic 60-40 stock bond mix. But in today's environment, challenges like persistent inflation and high volatility mean the old rules don't always provide the same protection or returns. Public markets have also become highly efficient, making access returns harder to capture. Investors are turning to alternatives to address risk, unlock new sources of return, and diversify beyond traditional stocks and bonds. At Liquidity.io, we see clients approaching alternatives not just for higher returns, but for better risk management, income stability, and genuine diversification.
For many alternatives used to be out of reach, reserved for institutional investors or ultra high net worth investor. What is changed and how is liquidity.io making alternatives more accessible?
It's true. The market has evolved rapidly. Innovations like tokenization, fractional ownership, and digital platforms mean minimum investments broader. Investors can now participate in private market opportunities with more modest allocations through liquidity.io. Our mission is to democratize access, reducing paperwork, simplifying structures, and creating transparent liquidity mechanisms so investors aren't locked away for 10 plus years as with traditional closed end funds.
Let's talk about the practical roles alternatives play in a portfolio. How should investor be thinking about allocation for returns, income, or diversification?
Great question. Alternatives can serve multiple purposes. Alpha. Private equity and venture capital can generate outsized returns, particularly in niche and emerging sectors. Income. Private credit and real estate, available via liquidity.io, deliver attractive yields, often higher than traditional bonds. Diversification. Infrastructure and other private assets show low or even negative correlation with mainstream equities and bonds. The key is mixing across asset classes. At liquidity.io, we emphasize what we call double diversification across assets, sectors, managers, and geographies.
How would investors fund these alternative allocations? Should they shift money from specific parts of their portfolios?
It depends on the role of the allocation. Return enhancers like private equity are typically funded from equities. Income focused alternatives like private credit often replace bonds or public credit. Real estate and infrastructure can come from either side, depending on whether the investor prioritizes income growth or tax efficiency. Liquidity.io's platform allows investors to reallocate flexibility based on these pools.
Manager selection is often cited as critical in alternatives. Is there more variation among providers in private markets?
Absolutely. Dispersion between top and bottom performers in private markets is far greater than public markets. That's why Liquidity.io carefully manager, partners, and experienced sponsors and diversifies across multiple providers to help investors avoid concentration risk. Manager quality is one of the largest drivers of long term outcomes.
Volatility and liquidity risk are frequent concerns. How should client understand these relative to public markets?
Private assets are priced less frequently, so reported volatility often look lower. For instance, private equity typically shows under 10% volatility versus 15% for the S&P 500. But the real challenge is illiquidity. Investors should expect to commit capital for longer periods. Liquidity.io offers interval funds, redemption windows, and secondary access, but transparency is vital. Investors should plan with a long term horizon in mind.
Looking ahead, how do you see the alternative investment landscape evolving and what is liquidity.io's vision for the future?
Growth potential is huge. Right now, individual investors have less than 5% of assets in alternatives, compared to 30 to 50% for larger institutions. Even a small shift, say from 5% to 10%, represents trillions in capital flows into alternatives. Liquidity.io's vision is clear: accessibility, lowering barriers with tech enabled structures, education, equipping investors with knowledge to invest wisely, resilience, guiding investors towards well diversified, balanced portfolios.
Thank you for the valuable insights and sharing a distinctly liquidity.io perspective. And to our listeners, thank you for joining us on Alternative Realities. In our next episode, we will explore sector specific opportunities and the future of alternative investing. Stay tuned to liquidity.io for more expert conversations and actionable ideas.
Thank you.